Markets are widely expecting a third quarter point cut in the last Fed meeting of the year. The Refinitiv odds are at 91% today. But our next guest says the market has it wrong and easing is a mistake because inflation is well above target. Joining us now is Jason Furman, former chair of the Council of Economic Advisors under President Obama, now with Harvard's Kennedy School. Jason, it's great to have you here. I did ask our previous, more dovish guest, I don't know if you caught that, why he thinks that, you're wrong about this. And his explanation is basically because the government is not pumping liquidity into the system the same way that we were in 2021, so inflation's less of a problem now. I don't know if you want to pick up that thread.
Sure. So first of all, I think they are going to cut rates today. So I don't think the market's wrong in its prediction. I think the Fed is wrong in its decision. And I partly agree with your guest. I think the inflation was largely fiscal in 2021 and 2022. But right now, the continuation of inflation is also partly fiscal. We're continuing to run a large budget deficit. It's actually going to go up a little bit over the next year. And so that means the Fed needs to do now what it basically was way too slow to do in 2021, which is offset all of that expansionary demand policy. And yes, we should have higher long rates, but the only way to get there is if people aren't expecting so many cuts to the short rate as they are right now.
So you would get a higher 10-year yield to lean against the AI bubble and everything else and to lean against inflation. But you'd get there by basically saying, well, it's because the Fed's not going to keep cutting interest rates. What about the little guy? What about the small banks? What about smaller companies? What about the public who thinks, I need a break here. I could use lower rates.
Look, if you want to have lower rates, the government's going to have to lower its budget deficit. As long as we're doing expansionary fiscal policy, at the same time that we have enormously expansionary financial conditions coming from the huge run-up in asset prices, that just means the system is awash in demand. Inflation's a percentage point above target. The unemployment rate is only a tenth or two above its target. And so the Fed needs to keep its focus on inflation. And ultimately, that's the right thing for everyone. But yeah, it does require more rate increases than it would if we weren't increasing the budget deficit in the way that we've been doing.
I do think it's a bit of a confusing time. You have terrible consumer sentiment, even while gas is below $3 a barrel. You have the president talking about an affordability crisis, while at the same time the Fed's talking about lowering rates. Let me play, actually, the president speaking last night about the economy and inflation, and he promises they're combating it. Here's what he said.
You're getting lower prices, bigger paychecks. We're getting inflation. We're crushing it. And you're getting much higher wages. I mean, the only thing that's really going up big, it's called the stock market and your 401ks. It's going up.
Jason, how would you respond?
Yeah, I mean, he has a tool that could make things more affordable, and it would be to drop his tariffs. The wonderful thing there is he doesn't even need congressional legislation. He can do it with a stroke of the pen. He could do it before the Supreme Court comes and rules on some of the tariffs that he's done. There's no doubt that part of why goods prices are up this year is tariffs. In fact, he himself said it. He talked about how people wouldn't be able to afford as many dolls. The vice president talked about how we can afford to pay more for toasters made in America. I don't think that was the right attitude on trade. I'd love to see them, undo that self-inflicted wound.